So, welcome all of you. Today, we would be discussing GAAP, which is Generally Accepted Accounting Principles. So, what is GAAP? A combination of accounting standards set by the policy board plus accepted ways of doing accounting. So, let us have a better understanding by looking at the definition of GAAP. A set of written rules issued by the accounting board which all companies have to mandatorily follow to prepare their financial statements. So which means the GAAP is primarily influenced by the international accounting standards, and India it is primarily followed in terms of the Indian accounting standard issued by the Institute of Chartered Accountants of India, which is similar to international accounting standards. Now let us discuss one of the most important aspects of accounting, which is the accounting principles. And some of the accounting principles are the entity concept, the dual aspect concept, the accrual concept, the money measurement concept, the going concern concept, the accounting period concept, realization concept, conservatism concept, consistency concept, and lastly the materiality concept. So these are the 10 most important accounting principles or the accounting concepts which helps an accountant to follow a defined guideline as per which is issued as per the accounting board by the accounting board. Now it is important to understand each of these concepts in detail so that the future roadmap is clear for an accountant while he is doing accounting for his organization. Now let us see what is an entity concept. Entity concept states that a business and an owner in a business has a separate entity of its own. When an owner invests in the business owes back the money to the owner. What does it simply means? Let us understand this with this infographic. So there is a business house which is called maybe a business house A, and there is a business owner which is Mr. X. So Mr. X invests a certain money in business house A, which primarily means Mr. X is different from this business house A. So they are separate. There is a separate entity of their own. The business house is separate, which is business house A, and Mr. X is separate, who is the business owner who has invested his money into the business. So they are not equal and they are separate. So whenever Mr. X invests into the business house A, he owes back that money from the business house A back to his own pocket, and the money does not belong to the business house but the money belongs to the business owner. This is a very important concept in accounting and must be carefully kept in mind by all the accountants. The second important concept of accounting is the duality concept, which states that each transaction has a twofold effect in the recording of transaction, and hence it is called the duality principle. So what does it mean? Let us understand it with an example and an explanation. For example, if a cash is spent in a business transaction, for example, if a cash is spent to buy a good worth rupees 50,000, then at one hand, what will happen? The expenses account will have an increase in the books, and at the same point of time, there will be a reduction in the cash account of the business. So what is happening? While making a cash purchase transaction, two things are happening. Two accounts are getting impacted. One is the expense account, which is increasing, and second is the cash account, which is decreasing. So this is called the duality concept, so that the two accounts are getting affected with one transaction, and this gives a birth to the concept of double entry system in accounting. Accrual concept of accounting. This is by and large the most important concept in accounting principles. Let us understand what is accrual accounting concept. This concept emphasis on recording of revenue of expense transactions based on their period of earning or incurring rather than the period of their receiving. So this is simple. It clearly says that whenever a revenue or an expense is incurred, that period is important rather than when the revenue is received or the expense is paid. So they can be better classified as below mentioned. Outstanding income, pre-received income, outstanding expense, and prepaid expense. Now let us understand each of these terms one by one to get a complete in-depth understanding of the accrual concept of accounting. Outstanding income. This outstanding income is also called income receivable, which is just nothing which states that the income which is earned now but due to be received in future. So as per the accrual concept, this is an income which is earned now, so it should be accounted for. So what the explanation says, if an income is earned in the current financial year but will be received in future to come, we will consider this earning and record this income for the current period and not for the future period. And it is a form of asset for the organization because it is an income receivable. So whenever any income is due to be received in future, it is always considered as an asset for that organization. While the pre-received income states that the income which is received in the current period but not earned for the current period. So here the income is not particularly earned for this period, however it is received for any future event. So explanation goes like this: if an income is received in the current financial year but will be earned in future to come, we will not consider this earning and record this income for the current period, and we will consider it only for the future period and not for the current year. It is a form of liability for the organization. Coming to outstanding expense, an expense which is incurred now and to be paid in future. So if an expense is incurred in the current financial year but will be paid in future to come, we will consider this expense because the income is because the expense is incurred now, and we will record this for the current period and not for the future period. So it is a form of liability for the organization. Coming to prepaid expense, which is paid in advance but not incurred for the current period. So going with the accrual concept, if the expense is paid in the current financial year but will be due in future to come, we will not consider this expense and record this expense for the future period and not for the current year. It is a form of asset for the organization. This simply means that whenever any expense is incurred, we will take the period of incurring of the expenses rather than making the payment of the expense. And similar, the case goes in form of income. When the income is earned, it is to be accounted for and not when it is being received. The next important concept is the money measurement concept. This concept emphasizes on the importance of money measurement. It says that any transaction which is recorded in the books of account has to be quantified in terms of monetary value. So let us understand it with the help of an example. Good purchase for Indian rupee 50,000. So this transaction can be recorded in accounting but on the other hand, if a statement is given as good purchased but the monetary value is not given, then the transaction cannot be recorded as this does not have a monetary value. So the concept simply implies that any transaction which has a monetary value can only be recorded in accounting. Otherwise, if any transaction does not have a monetary value, a quantified monetary value, it will not be recorded. Everything has to be measured in terms of money, following the money measurement concept of accounting. The next important principle is the going concern concept. The going concern concept emphasizes on the continuity approach of a business, and it clearly states that the business is formed to exist for an undefined period in future. So this is a kind of optimistic approach based on which the accounting premises rest upon. Next is the accounting period concept. This concept emphasizes on a time period for which the business transaction will be recorded and assimilated in form of financial statement to give a financial result and position of a business for a particular period. So the concept is quite simple. It clearly says that any recording of transaction should be defined by an accounting period. For example, in India, the accounting period is taken from April to March, and which is also called the financial year for accounting purpose. So any transaction which is happening from 1st April to March will be a financial performance for the accounting period of April to March, and so on, so forth. The next concept is the realization concept, and this concept states that revenue can only be recognized once the underlying goods or services associated with the revenue has been delivered or rendered, respectively. It is a kind of extension of the accrual concept what we discussed earlier. To better understand it with an example, if Indian rupee 10,000 is received against an order to a manufacturing firm, then till the time the order is executed or dispatched to the buyer, the money received will be considered as a liability for the firm. But once the good is dispatched and the sale is executed, it will be considered as a realized income. The next principle is the conservatism concept, which state that the firm focuses on minimizing profits by recording uncertain losses or expenses and not recording uncertain and estimated gains, which means that basically the firm focuses on to ensure better future estimates of the financial results of the business by minimizing the profit and also by ensuring that unaccounted for gains are not recorded, uncertain gains are not recorded in the business transaction. The consistency concept. This concept states that once an accounting method is followed, it will be consistent for future accounting purpose, as well as unless it is unregulated by an accounting board with an introduction of a new accounting method. So once a method is defined for an accounting, it will continue to follow in the future as well. The last concept is the materiality concept. This concept states that only trivial matters can be disregarded in accounting, which are very minute and which does not impact the financial position or the financial result, and all other important transactions to be disclosed completely, which are relevant, sizable, and impact the financial result or position of an organization. So I hope the information what we have shared in this video will be helpful to you in understanding the accounting principles, and we thank you for your patience and stay tuned. And also, if you find the information relevant, please like and subscribe to our video. Thank you.